Good evening. This is Ken Long from Tortoise Capital with a review of the weekend trading report for December 7th, 2013. The market remains in bullish, quiet conditions. On an annual basis, using weekly RSI 14, it's at overbought at 76 out of 100. It can stay that way for a long time. On a 10-day basis, the short-term basis, it's at the high end of neutral with a score of 79 out of 100 on the 10-day NDX. Looking at the market mosaic and price relative to the 200-day moving average, we're white bullish at 9.63%, so 7.5% cushion between here and sideways markets. The slope of the 50-day moving average is white bullish at 0.61%. The ADX is degraded to 21.6, so no longer strongly trending. It's now neutral. ATR percentage increased slightly to 0.72%, but still well within the range of quiet. The risk index is the 30-period moving average of the VIX divided by the 10-period. That comes in at a score of 0.96, which puts us in risk-off conditions. If we take a look at that value of 0.96, compare it to the last 5,000 days, it gives us a Z-score of minus 0.56, which you see reflected here in the 90-day time series. And so this is a market that is subject to sharp volatility spikes like we saw earlier this week. In the blended month rebalancing, the holdings remain technology, small caps in the S&P in the 13 ETF portfolio. In the 22 and 32 ETF portfolios, it's U.S. tech, industrials, and consumer discretionary, with the next reevaluation being due on or about 1 January. Currently, in ETF2, the theoretical exposure is 80% in the model, and the model portfolio remains at 100%, with some stops being adjusted up this week. This is just another summary of the 13 and the 32 ETF portfolio. You see about half of them are on cash signals in the 13. With tech, small caps, and then mid caps in the top three positions. The top three positions in the 32 ETF remain industrials, the technology, consumer discretionary, still dominated by the U.S. right now. You can see most of the signals that are in cash are globals, or commodity-based ETFs, along with gold at the very bottom of the list. Looking at the ETF Max, these are the top 50 out of a database of about 1,500 ETFs. And the top position was relinquished by TAN, first time in a long time. KWT, the other solar energy ETF, is at the top, but both suffered some drawdowns this week. As you know, I like to look at those that are on that are green on the 3-month and white on the 6-month percentage, with the belief that those are earlier in their outperformance cycle. That would lead us to India with INXX and SMIN. We would see golden dragons continuing to decline with the values of white and green. Poland on the way up with green and white. India, another India, so maybe that's where we ought to be looking. Social media is slowing down at white and then green, as is the global wind. But otherwise, you can see the remaining symbols for yourself. Looking at the market health check now, the dark blue shaded region in the middle is the river. That's the 30-period Bollinger Band plus or minus 1. The lighter blue shaded area is the floodplain. It's a Bollinger Band plus or minus 2. The vertical lines are 10, 20, and 30 days worth of look back. The blue channel is the 10-period regression line, the RAF regression channel 10 period, that's sloping down over the last 10 days. The black channel in the middle is the 30 period regression line and channel, lagged by a day, and the green represents the 90 or the long term. So we have the long term, mid term, and short term. Only the short term has pulled it back a little bit. It was offset somewhat by the gap up on Friday, which held over the weekend. Um, I am counting the green zone as a new breakout from the swing high at about 182. That's what we'd have to see to believe in the continuation of this bullish move up, which is indicated by the 30 and the 90 regression lines, long and strong on the upside. The pullback this week came back very near to the Bollinger Band mean, and then the good jobs report on Friday gave a one-day pop. We'll see if that holds. I'm treating the yellow zone or the tactical noise as between 182 and about 178, which is the support level that's currently right at the Bollinger Band mean and the lower channel of the RAF regression line and RAF regression channel. You can see the 200-day moving average in that region below it, highlighted in red here. These horizontal red lines represent support levels that have been resistance levels in the past that were broken through and then became support. They become targets on the downside should we see price begin to decay here. The 30-day regression line slope, the time series that is this sine wave looking thin black line. You can see where it's in the blue circles where it's reached local maximums and also where it's crossed the zero line when it went negative. So we're in an extended edge here of about 40 trading days of outperformance. The slope has decayed over the last 10 or 15 days as it's been more sideways and choppy, but it is still positive as long as it's above this dotted line. It's still positive, and with price at the edge of the river and heading back into the floodplain, the potential for another move up to 190 is certainly still there, with a base at 178. So this is still a long and strong bull market. You can see that we dipped into oversold conditions briefly, for a day. And the intermediate indicator, the percent price oscillator, has its jaws open to the downside. Review of the ETF2 regional report. 2 of the 10 regions are on cash signals, and that's EPP, Asian List Japan, and Latin America, the 2 perennial weak ones this year. And that's what gets the model to 80% invested, 20% cash. You see the S&P at 82 is slightly better now than EFA, the globals, at 81. Inside the U.S., strength is in technology, then small caps, then large caps, then mid caps among these four U.S. indexes. And then the 2 strongest sectors, technology and small caps, and the 2 weakest, Latin American emerging markets. You can see how the sector spiders reflect strength inside the U.S. with industrials, healthcare, and discretionary leading the way, and with utilities lagging. World market model takes the same lens and now expands it out to regions and countries. You see the U.S. is all above average, and then strength in technology and across the small caps as well. China exceptionally strong. Everything Europe is well above average except for Sweden, which is lagging. Mexico above average, but Canada, Brazil, Latin America below average. Emerging markets have come back above average. Weakness in oil, gold, and silver. Private equity remains strong. Treasuries, corporate bonds, and real estate. The alternative investments are lagging. Inside the business sectors, it's just about a draw between the U.S. versus the global, with only U.S. industrials really showing some strength here. Top ETFs from the ETF2 database. This is similar to the lens that gives us the blended monthly rebalancing, but incorporates a few more measures. And these are all ETFs that have an average daily volume greater than 100,000 shares. So solar, Greece, pharmaceuticals, Poland, more pharmaceuticals, golden dragons, We like those that are green and white, but we don't have any of those in this stack. This looks like Poland and Spain starting to decay a little bit because they're. Oh, I'm sorry. I got the wrong column. So pharmaceuticals is actually green and white, as is regional banks, Germany, the producers index, and then this whole stack from small cap growth all the way down are all green and white. And so these are areas of emerging strength that should be of interest. That's where I think the new leaders will come from. Small caps are very heavily reflected inside here. Um, the Dow 30, Boeing has moved to the top, remains at the top. Boeing and Nike have been very strong for months now. New emerging leaders are the ones that are in green and white, same logic. 3M, Visa, Walt Disney, American Express, GE, and Microsoft at the bottom of the stack. IBM and Cisco. IBM is continuing to be weak with a red on strength and a yellow on consistency, and Cisco's just been horrible. Shifting to the daily report, we have a index channeling signal in EPP. You can see the decay in volatility here over the last 180 days, and again the decay in ADX and strength of trend over the last 15 days as the market has basically been going sideways. A handful of signals in the 551W, 3M, Pfizer, Home Depot, United Tech, and Boeing. And then the auto framer has half a dozen that fire on a mechanical calculation of price relative to the 10-day high, and yesterday's low was the risk. In the Dow 30 tactical summary, nothing fires on the RSI2. We have a handful that test out good on the auto framer, and then the top five max pain range compressions: 3M, AT&T, Chevron, Pfizer, and IBM. A couple dojis in AT&T and Pfizer. Inside ETF 30, again half a dozen signals on the auto framer, half a dozen dojis. Asia less Japan looks interesting as it tests out at 4.1 to 1. It's number 4 on the MPRC. It's a max pain. It's a doji, a channeling, and an overreaction signal, so that should be of interest. The VIX got punched in the mouth on Friday with losing 3.4%. Just a quick review of the auto framer for computing mechanical entries and exits. The 30-day regression line is the blue line. The time series over the last 30 days is reflected in blue, and the 10-day moving average in black. And so we're very close to the 6-month average here, and you can see how that is reflected in a time series over the last 180. The pullback that was suggested about 10 days ago, everything's come back to normal, and now we're right at a really important transition point here with price resting at its all-time swing high here, and a one-day price bump anomaly is our follow-through. That's going to look favorable to a lot of folks reading the news over the weekend. Or was that a gap trap? In any case, strong support at 179 to 178. If that fails, then look out below and it's back to 176, 175. Just a few reference charts now without comment. I'll point out now on these z-scores of the regression line slopes, the long-term market is really favorable now as it's on a long-term basis. That 90-day regression line slope is really powerful, as strong as it's been in almost the last 180 days. The 30 has pulled back into the normal. The 10 has cooled and pulled back into normal and just started to hook up on Friday. So that's actually a very favorable event. The pullbacks in the 30 and the 10 provide a little bit of cooling off period that allows money to get reinvested on a trading basis. We've been finding support here at the upper edge of the river, have barely even gotten back to test the Bollinger Band mean. So this looks very strong. Where some key asset classes are inside with respect to their own river. So the S&P right at the boundary of its river, treasuries and gold falling out of the river, and U.S. small caps very strong. Some frog stats. And that's everything I want to look at for this weekend. Keep your powder dry and your risk measured.